Welcome to the deep dive. We're here to cut through the noise of complex financial reports, really pull out the key insights.
That's the plan.
Today, we're taking a deep dive into Bajaj Housing Finance Ltd, BHFL. We're looking at their unaudited results for the quarter ending June 30, 2025.
Right. The Q1 FY26 numbers just came out.
Exactly. So our mission here is to go beyond just the headline figures. We want to understand what's driving these numbers, what management's saying about the future,
And what it all means, really.
for you, our listener, trying to make sense of it all. Okay, let's dive in. Let's see what's really happening beneath the surface at Bajaj Housing Finance this quarter. All right, let's kick things off. The big picture first. What were the headline figures, the numbers that immediately grabbed your attention?
Well, the growth is pretty consistent, which is notable. Their assets under management, the AUM, it jumped 24% year on year.
24%, that's solid.
Yeah, hit 1,020,420 crore. And loan assets grew basically in lockstep, also 24%, reaching 4,005,954 crore.
Okay, and profitability?
Profit after tax, or PTAC, that was up a healthy 21% year on year. Came in at 583 crore.
Nice.
Disbursements were strong too, up 22% to about 14,651 crore.
Yeah.
What's interesting though,
Go on.
management called it a balanced quarter. They acknowledged competitive pricing, maybe some real estate moderation. But despite that context, these year-on-year growth numbers, especially AUM and PADIA, they're quite robust. It really points to some underlying strength, not just riding a wave.
The AUM growth, yeah, especially given the competition, that stands out. But how are they actually turning that into income? Net interest income, NII, jumped 33% year on year. That's huge.
It is 887 crore. And net total income, NTI, also up significantly, 25% year on year to 1,012 crore.
So what's the secret sauce there? How do they manage such big income jumps?
A big part of it, maybe the key part, is how they manage their cost of funds. It actually decreased sequentially.
Oh, interesting. By how much?
By 21 basis points compared to Q4, down to 7.7%. They basically got cheaper funding some new borrowings at lower rates, plus benefits from wider rate cuts filtering through.
Right.
And that reduction was absolutely crucial. It helped them keep their net interest margin, their NIM, stable at 4.0%, flat compared to the last quarter.
Even though yields came down slightly?
Exactly. Portfolio yields actually dipped 20 basis points sequentially, down to 9.5%. So cutting their borrowing costs was what really protected that margin. It's smart treasury management, essentially.
Okay, so they're being efficient on the funding side. What about operational efficiency? OPEX to NTI. How did that look?
Right. The operating expenses to net total income ratio,
Right.
it came in at 21.2% this quarter.
Which sounds pretty much flat compared to last year, right?
Wow.
21.0% in Q1 FY25.
On the surface, yes, largely flat.
Good.
But this is where you have to look a bit deeper. Management explained this wasn't stagnation.
Okay.
It's actually because they're continuing to invest, pouring money into new strategic business units, SBUs, and expanding into non-metro markets.
Ah, so investment spending is keeping the ratio steady, even if efficiencies are improving elsewhere.
Precisely. They stressed they are driving efficiencies, but the NTI moderation sort of masks it in the ratio calculation.
Yeah.
They even suggested if NTI had been higher, like last year, the ratio might have looked closer to, say, 19%.
Got it. And this expansion, new SBUs, non-metro focus, that usually means hiring, right? Did they mention headcount?
They did. Current employee count is 2,017 as of June 30th. So, yeah, reflecting that investment in growth.
Okay, let's shift gears a bit. Asset quality, always critical for a lender. Now, BHFL's numbers are still very low, which is good,
Definitely.
but there was a tiny uptick. Gross NPAs, GNPA, edged up to 0.30% from 0.29% last quarter. Net NPA also nudged up a bit to 0.13%. Should we read anything into that?
It's a fair question, and something to watch for sure, even if the moves are marginal. Management's take was interesting.
How so?
They essentially said these slight swings and the related changes in the provision coverage ratio, or PCR, are mostly noise because the total NPA pool is quite small, only around 300 crore.
I see. So a few individual cases moving can skew the percentage.
Exactly. It doesn't necessarily signal a wider trend or a change in their credit policy.
Yeah.
Their target PCR, based on their internal model, is around 40%, but they might hold more based on specific risk assessments. It's not a hard ceiling.
Okay, so context matters there. Less of a red flag, more statistical noise on a small base. What about actual loan losses and provisions booked?
Those did increase, 41 crore this quarter, up from 10 crore in Q1 last year.
That looks like a jump.
It does. But there's a key piece of context. In Q1 FY25, they had a Euro 25 crore overlay release. Basically, they released some extra provisions they'd set aside earlier.
Ah, okay.
If you adjust for that normalized Q1 FY25 number, the credit cost back then would have been around 0.17%. This quarter's annualized credit cost was 0.16%.
So on a like-for-like basis, it actually looks slightly better.
Correct. Suggests underlying credit performance is pretty stable, and their PCR on the actual bad loans, stage 3 assets, was 56.3% at the end of June.
That's helpful context, thanks. All right, let's talk feel. How are they funding all this growth? Capital adequacy looks really strong.
Extremely strong. Capital adequacy ratio, CRAR, is at 26.94%, way above the 15% regulatory minimum.
In Tier 1.
26.43%. Their net worth is substantial too, over 20,500 crore. Leverage is comfortable at 5.4 times.
And they've got that top-tier credit rating, triple stable. That's a massive advantage in borrowing, isn't it?
Oh, absolutely. It's huge. It means cheaper funds, more access. And what's fascinating is how they're using that advantage.
What do you mean?
They mentioned strategically leaning more on non-convertible debentures, NCDs, for new funding, even when market rates were maybe a bit higher overall.
Why do that?
They found the price differential versus bank loans more attractive, especially when factoring in potential future rate cuts. It's like locking in a decent long-term rate now because you expect short-term rates might fluctuate or bank pricing might shift. Shows a really dynamic treasury approach.
Interesting. Proactive management.
Yeah. And their overall borrowing mix is well diversified. Money markets are about 53%, bank borrowings 37%, and NHB refinance 10%. Importantly, they also confirmed all the money raised from recent public issues and private placements was used exactly as planned. No deviations.
Good governance check there. So strong capital, smart funding. How are they deploying it? We know they're growing, but where? What does the loan book look like now?
Right, the portfolio mix is revealing. As of June 30th, home loans are the biggest chunk, but maybe less dominant than you'd think, 55.8%.
Okay, what else?
Lease rental discounting, LRD, is quite significant now at 20.4%. Developer finance, DF, is 11.9%, and loan against property, LAP, is 10.5%. Then a small slice of others.
So definitely not just a pure home loan player, and you mentioned a trend there.
Yeah, if you look back, say, to FY22, home loans were a slightly higher percentage. LRD and developer finance have grown as a share of the book.
Why is that diversification important?
Well, first, there's a regulatory angle. As a housing finance company, an HFC, they need to meet the principal business criteria, PBC. Over 60% in housing-related assets.
And they are.
They're at 61.71%. So this mix keeps them compliant. But strategically, it lets them optimize risk and return. Management even said they see LAP and LRD as somewhat interchangeable depending on the market dynamics. They saw good metrics in LAP recently, so its growth was strong.
So they can pivot between those non-housing segments based on opportunity. Smart.
Exactly. It adds flexibility.
Beyond the loan products, what about how they operate? Are they leveraging tech, digital initiatives?
Oh, definitely. That seems to be a big focus. E-agreements, for instance, penetration is at 93%. That's very high.
Wow.
And online customer onboarding, 88% in June. So huge digital adoption there, which clearly drives efficiency.
Makes sense.
Plus, they talked about robust underwriting, centralized hubs, system-driven credit memos, even tele and video verification, and managing debt collection in-house. It all ties back to maintaining that healthy asset quality we discussed earlier.
Right, it's all connected. Digital efficiencies supporting prudent risk management. Okay, let's look ahead now. The future. Management's outlook for FY26. What's the headline there?
The main headline, the most significant change, is a moderation in their AUM growth guidance for this year, FY26.
Moderation. How much?
They're now assessing growth in the range of 21–23%. That's down from their previous medium-term guidance, which is more like 24–26%.
Okay, let's unpack that. Why the recalibration? What's driving the slightly slower growth expectation?
It really raises a key question about the current market. Management pointed to three main things.
Which are?
1, heightened competitive pricing. It's tough out there acquiring new loans. 2, increased portfolio attrition customers switching lenders for better rates.
See more of that happening.
Apparently so.
Yeah.
And 3, just a slight moderation in overall real estate demand compared to maybe peak levels.
The competition, churn, and maybe a bit less market tailwind.
Pretty much sums it up. But they do expect things like pricing pressure and attrition to stabilize later in the year, maybe around Q3, hoping to get back to their usual growth rhythm then.
So a temporary adjustment to market conditions is how they see it. What about other financial metrics for FY26? OPEX.
OPEX to NTI, they expect that to stay flat, around 20-21%. Net interest income, NII, also expected to be pretty stable, similar to FY25 levels.
But NIM is expected to moderate.
Yes, NIM, or looking at it as net total income as a percentage of assets, they expect that to moderate by about 15 to 20 basis points.
And why is that?
Two main reasons given. Lower income from investments. They had a lot of cash post-capital raises last year, earning less now. And lower income expected from selling off loans, what they call derecognized loans, planning fewer of those transactions.
Okay. And that flows through to returns, ROA and ROE.
It does. Return on assets, ROA, expected to stay in the 2.0–2.2% range. But return on equity, ROE, is expected to moderate down to 11–12%.
Why the dip in ROE specifically?
They called it an equity overhang. Basically, they raised a lot of capital in 2 rounds last year, which is good for the balance sheet and future growth. But until that capital is fully deployed and earning returns, it mathematically dilutes the ROE percentage. More equity base, same or slightly moderated profit growth in the short term.
Got it. Makes sense. Risk metrics holding steady, though. MPAs, credit costs.
Yeah, they expect those to remain within their medium-term guidance ranges. So GNPA, 35–40 basis points, credit cost, 15–20 basis points, PCR, 50–60%. No major worries signaled there.
And the interest rate environment, always a big factor.
Huge. They noted the recent repo rate cuts, 45 basis points in total since February, including the latest 20 BPs cut on July 1st.
Are they expecting more cuts?
They're factoring one more 25 basis point cut into their stress testing, so planning cautiously. They also acknowledged how competitive the home loan market is.
Right, you mentioned that.
Yeah, some public sector banks are offering rates like 7.3%. BHFL's lowest is 7.49% for prime customers. They did note a bit of a slowdown in pure home loan demand. That segment is now about 50.9% of their book.
And their strategy within that competitive space?
They emphasized organic growth, focusing on near-prime and affordable housing segments. They specifically mentioned not relying heavily on co-lending partnerships, which is a different path than some other players are taking.
Interesting strategic choice. So looking back before we wrap up, it's clear BHFL has been on quite a journey.
Absolutely. You look at the last 8 years, FY18 to FY25, the growth has been phenomenal. AUM CAGR of 64%, PAT CAGR 116%, PBT TGR 120%. That shows incredible resilience and execution over time.
Sets the context for this quarter's more balanced performance.
Exactly. And remember, they're an upper layer at IBFC under RBI rules, a significant player in a housing sector that's vital for the economy, supported by government-focused RERA regulations. It's a fundamentally important market, even with cyclical ups and downs, and asset quality across the sector, broadly speaking, remains quite healthy.
Okay, so wrapping it all up for you, our listener, you've got a clearer picture now of Bajaj Housing Finance's recent performance. Solid growth overall, but facing some market headwinds.
Strategic financial management, especially on costs, keeping margins relatively stable.
And a clear strategy focused on diversification, digital efficiency, and organic growth, albeit with slightly moderated expectations for the immediate year ahead. You're definitely better equipped now to understand their position in this dynamic Indian housing finance market.
Absolutely.
So here's a final thought to leave you with. Considering Bajaj Housing Finance's clear pivot towards optimizing its loan mix, investing in those new segments, all while navigating this intense competition, how might their strong push into digital transformation become an even bigger advantage? Could it amplify their ability to grab market share, navigate future interest rate cycles, even if the overall market sort of stays flat or sideways for a while? Something to ponder about the interplay of strategy, technology, and market dynamics.